In 2021, if you told Wall Street that an insurtech startup was going to achieve a 95.8% combined ratio while simultaneously scaling their top line premium by 61%.
I mean, they would have left you right out of the room, literally.
Exactly. The narrative back then was just set in stone. Like, technology companies could build really pretty smartphone apps. They could acquire customers with slick marketing, but they had absolutely no idea how to price underlying risk.
Right. It was just assumed they would burn through venture capital until the claims inevitably crushed them.
Yeah. But today is August 3, 2026, and we're looking at a company that didn't just beat that legacy narrative. I mean, they completely shattered it. Welcome to Talk Tickers.
Glad to be here.
Normally, our mission is to get you in, get you out, and give you the actionable bottom line on a corporate earnings call in under 5 minutes. We translate the jargon, give you the data, and let you get back to the market.
Keep it moving.
Right. But every once in a while, a company drops a quarter that is just so structurally transformative. Well, a 5-minute summary would just be doing a disservice to your portfolio.
Yeah.
So today, we are tearing up the clock. We are doing a full deep dive into the Q2 2026 earnings call for Hippo Holdings Inc.
Trading under the ticker symbol HIPO.
Okay, let's unpack this, because what Hippo, led by CEO Rick McCathron and CFO Guy Zeltser, just reported, it's a complete paradigm shift.
Yeah.
I mean, we are looking at a fundamentally rewired enterprise here.
It really is a profound shift, yeah. And not just for this specific company, but as a proof of concept for the entire premise of technology-driven insurance.
Right.
When we look at the raw data coming out of this Q2 call, we are not analyzing the same entity that went public a few years ago. The market still largely prices insurtechs based on their historical inability to manage loss ratios.
Right, because the traditional life cycle of these companies involve like hyper-growth fueled by underpricing legacy carriers.
Right. Exactly. Underpriced to get growth, and then catastrophic losses hit when weather events happen, and then they have to do massive capital raises just to stay afloat.
Just to keep the lights on.
Yeah. But what we are seeing in this transcript is the exact inverse of that doomed cycle. We are seeing a company aggressively capturing market share while actively tightening its underwriting standards.
That's just wild.
It is. And perhaps most impressively, they're shrinking their operational footprint relative to the revenue they bring in.
So I want to start with the headline numbers, because they are, the foundation of everything else we're going to discuss today.
Mm-hmm.
I am looking at gross written premium, what the industry calls GWP.
Yep.
They hit $482 million for the quarter. That is a massive 61% year-over-year growth rate. And total revenue reached $145 million, which is up 23% from the second quarter of the prior year.
Those are strong top-line numbers, yeah.
They are, but the number that I think really forces the market to sit up and pay attention is the bottom line. Net income swung to a positive $10 million, or 0.38 cents per diluted share.
Which is huge.
Right. That's a $9 million improvement from this exact time last year. And looking at adjusted net income, it came in at $21 million, or 79 cents per diluted share, a 24% increase. So to put it bluntly, they are generating actual bottom line profit.
And we really should pause on that profitability metric, because the context here is vital. This marks Hippo's 5th consecutive quarter of profitability on both a stated and adjusted consensus.
Wow, 5 quarters in a row.
Yeah, and in the insurance sector, stringing together 5 quarters in the black, well, that's the threshold where a fluke becomes a structural reality,
Because you can't just blame it on the weather anymore.
Exactly. If an insurance company is profitable for 1 or 2 quarters, you can often chalk it up to like a suspiciously quiet hurricane season, or a lack of severe convective storms in the Midwest, or maybe just a one-time release of capital reserves.
Right, just getting lucky for a few months.
But 5 consecutive quarters covers more than a full calendar year. I mean, it encompasses every season, every typical weather pattern, and the natural ebb and flow of the macroeconomic environment. It proves that the business model itself is generating the margin, not just a lucky streak.
So that distinction between good luck and a good model, it really brings us to a metric that I know trips up a lot of retail investors, and that's the net combined ratio.
Oh yeah, the golden metric.
Right. The earnings report states that Hippo's net combined ratio improved by 4 percentage points year over year, bringing it down to 95.8%. Mm-hmm. Now, I understand that anything under 100% is considered good, but I want to break down the actual mechanics of this number. Like, how does a 4% improvement happen, and what's the baseline we should be comparing this 95.8% against?
So the combined ratio is really the pulse of any insurance operation. It measures the operational profitability of the company before you even factor in any investment income. Because, insurance companies take your premium, they hold on to it, and they invest it in bonds or other securities until they need to pay a claim. That investment income is a nice bonus, but the combined ratio asks a simpler question.
Which is?
Are you making money on the actual act of insuring people? It is calculated by taking the total incurred losses plus the operational expenses and simply dividing that by the earned premium.
Got it.
So a 100% combined ratio means that for every dollar of premium collected, exactly $1 goes out the door to pay claims, pay the staff, keep the lights on, they break even.
Meaning a 95.8% combined ratio implies that for every dollar they earn, they are paying out 95.8 cents in claims and expenses.
Right.
Leaving them with 4.2 cents of pure underwriting profit.
That is the exact math. And to answer your question about the baseline, a 95.8% is exceptional in the current environment. Over the last few years, the property and casualty industry average has frequently hovered above 100%.
Really? Like industry-wide?
Yeah, sometimes pushing into the 103% or 104% range during years with heavy natural disasters. Legacy carriers have been literally bleeding money on their underwriting operations and relying on their investment portfolios to just bail them out.
Wow, okay.
So when Hippo reports a 4-point improvement, they are essentially saying they found a way to strip 4 cents of waste, loss, or expense out of every single dollar they process compared to last year.
Which adds up fast.
Exactly. When you apply that 4% operational improvement to hundreds of millions of dollars in premium, you start to see how that $10 million net income figure materialized. Furthermore, they achieved this 95.8% while still absorbing a 10% catastrophe loss ratio.
So they aren't dodging the weather.
No, they are absorbing normal catastrophe losses and still operating deeply in the black.
I have to admit, some genuine skepticism here, though. If I look at the historical timeline of the insurtech space, the narrative a few years ago was incredibly grim. Like these companies were dealing with skyrocketing loss ratios, inflationary pressures on building materials, and just a complete inability to get their expenses under control.
It was a mess, yeah.
So to see a company pivot from that environment to a 95.8% combined ratio with 5 quarters of profitability, it doesn't make intuitive sense. You can't just flip a switch and make an insurance portfolio profitable. Right?
No, absolutely not.
Because you're locked into annual contracts with your customers. You can't change your prices overnight. So how did they actually execute this turnaround?
The turnaround was rooted in a very painful, deliberate process called rate adequacy. You are completely right that you cannot pivot an insurance book quickly. It's a highly regulated industry.
Right.
If you want to charge your customers more money for their homeowners policy, you can't just, update your website. You have to submit a massive, actuarially justified rate filing to the Department of Insurance in every single state where you operate.
And the state has to approve it.
Exactly. And those state regulators review your data, and their primary mandate is often to protect consumers from price gouging, not to protect the insurance company's profit margins. This approval process can take 6 months to a year or even longer in states like California.
Which means, if you realize you are underpricing your risk today, you might not actually be able to collect the correct premium for another 18 months.
Precisely the problem. To achieve the numbers we're seeing in this Q2 2026 report, Hippo management had to see the macro trends years in advance. The inflation, the rising cost of lumber and labor, the increased frequency of severe weather.
So they started adjusting way back then.
Yeah. The transcript notes that over the past several years, they executed over 200 separate rate filings. The result of that massive administrative effort was an aggregate rate increase of over 100% to their home insurance program.
Wait, an aggregate rate increase of over 100%? They essentially doubled the cost of their coverage over a multi-year period.
Yes.
I mean, if a company doubles its prices, standard economic theory suggests they're going to lose a massive chunk of their customer base. Customers shop around,
They absolutely did lose customers, and that was entirely intentional.
Oh, really?
Yeah, they stopped trying to compete on being the cheapest option in the market because that strategy was destroying their balance sheet. They decided to only retain the customers who were willing to pay the actuarially sound price for the risk they actually represented.
So they were basically firing unprofitable customers.
Exactly. It was a conscious shedding of unprofitable business, and we can see the fruit of that labor in a very specific metric. Guy Zeltzer highlighted on the call, the core accident year ex-cat loss ratio.
Okay, ex-cat meaning excluding catastrophes.
Right. This metric looks at the performance of the underlying policies, stripping out the noise of major, unpredictable natural disasters. It tells you how good the company is at predicting standard risks like kitchen fires or burst pipes. That ratio improved to 45.8%. Zeltzer noted that they view mid-40s as an excellent result. I mean, they improved that specific underlying loss metric by nearly 17 points from Q2 of 2024. That requires unnatural discipline.
Okay, that makes sense of the internal mechanics, but to see if this is sustainable, we have to look at what they're actually insuring right now compared to a year ago. Because you can fake short-term profits in insurance by pulling back entirely from risky markets or taking on hidden long-tail risks.
Sure.
When I look at the gross written premium breakdown in this transcript, I see a company that has completely changed its identity. The market largely still thinks of Hippo as a direct-to-consumer home insurance app.
Which is outdated.
Right, because looking at the numbers, homeowners is now their third largest line of business at $107 million, which grew a very modest 7% year over year. The real volume is coming from casualty, which is their largest line at $180 million, and commercial multi-peril, sitting at $138 million. That's a massive 65% increase for CMP.
This metamorphosis is, frankly, the most strategic element of the entire earnings call. Management is demonstrating an active, agnostic approach to capital allocation. They are not romantically attached to the idea of being a pure-play homeowners brand.
So let's unpack the terminology here to understand the shift. What exactly is CMP?
CMP, or commercial multi-peril, is a bundled policy designed for businesses. It combines liability coverage, protecting the business if a customer slips and falls or sues for negligence, with property coverage, which protects the physical storefront and the inventory inside.
Okay, so it's a fundamental high-retention product for the small to medium business sector.
Exactly. What's fascinating here is how management actively chose to pivot into these markets while simultaneously pulling back from others.
Which brings up this strategic shift away from certain types of homeowners insurance. McCatherine specifically mentioned pulling back from E&S homeowner segments. I think we need to define E&S because it sounds like a lucrative area that a growth company would want to dominate.
E&S stands for excess and surplus lines. To understand E&S, you really have to understand how standard insurance works. The standard market is called the admitted market.
Admitted, okay.
Admitted carriers are licensed and heavily regulated by individual state insurance departments. The state dictates what they can cover, what forms they must use, and crucially, what rates they can charge.
Right.
But sometimes a risk is too complex, too unique, or simply too dangerous for an admitted carrier to touch. Think of a multi-million-dollar home built on the edge of a wildfire zone in California, or a coastal property in Florida with a history of hurricane damage.
So an admitted carrier looks at that and says, the state won't let us charge enough to cover that risk, so we are passing.
Exactly. And that is where the E&S market steps in. E&S carriers operate outside the strict rate and form regulations of the admitted market. Oh, I see. Because they are taking on higher non-standard risks, they have the freedom to charge significantly higher premiums and impose much stricter deductibles and exclusions. Historically, E&S is a highly profitable space because of that pricing freedom.
So if it's highly profitable and you have pricing freedom, why on earth is Hippo actively pulling capital out of the E&S homeowners market?
Because of market cycles. Insurance operates on a pendulum of hard and soft markets. McCatherine explicitly stated on the call that the E&S market is softer right now.
What does a soft market mean in this context?
A soft market occurs when there is an excess of capital floating around the industry looking for yield. When too many carriers and investors look at the high returns of the E&S market, they all rush in. That competition drives prices down and leads to looser underwriting standards as companies literally fight for market share.
Oh, so it's a race to the bottom.
Exactly. Hippo's management looked at the E&S space, saw that competitors were starting to underprice risks just to win business, and realized the math no longer worked in their favor. So instead of fighting that race to the bottom, they took their capital and deployed it into the admitted homeowners market through massive established partnerships with companies like Progressive and Westwood.
That is a level of capital agility you rarely see in this space. I mean, they are looking at the casino floor, realizing the odds on the E&S table have turned against them, so they just cash out and walk over to the casualty and admitted tables where the math is currently in their favor.
Right.
It shows they are managing a portfolio of risks, not just selling a single product.
And that portfolio approach is entirely driven by their MGA strategy. Casualty has exploded to become their largest line, driven by a multi-decade program partner. They aren't building a casualty division from scratch and trying to figure out how to underwrite it. They are acting as a capacity provider and a technology layer for managing general agents.
Okay, I need to stop you there because the term MGA, managing general agent, it gets thrown around constantly in these InsurTech calls, but the actual economic relationship is rarely explained. Like, how does the money actually flow between Hippo and an MGA? If the MGA is doing the work, who holds the risk?
It is a critical distinction. Think of an MGA as a highly specialized, outsourced insurance company that doesn't actually have its own balance sheet.
Okay.
Let's say there is an MGA that specializes exclusively in insuring veterinary clinics. They know exactly how to price the risk of a dog biting a vet tech or a fire starting in the kennels. They have the sales team, the specialized underwriting algorithms, the deep niche knowledge.
Right.
But they don't have the hundreds of millions of dollars in regulated capital required to legally pay out claims.
So they need a sponsor.
Yeah.
Like a sugar daddy with a regulated balance sheet.
Exactly. And that sponsor is the carrier, in this case, Hippo. Hippo provides the legal paper and the capital backing. The MGA sells the policy and underwrites the risk based on guidelines agreed upon with Hippo.
Okay, so the premium flows from the customer through the MGA and onto Hippo's balance sheet.
Yes. Hippo then pays the MGA a commission for finding and underwriting the business. Crucially, if that veterinary clinic burns down, it is Hippo's balance sheet that takes the hit to pay the claim. Hippo holds the risk.
Which brings up a massive structural risk, doesn't it? If the MGA gets paid a commission for every policy they write, but Hippo holds the bag if the policy has a claim, doesn't the MGA have an incentive to just write as much business as possible, regardless of the quality, just to rack up commissions?
You've just identified the historic flaw in the MGA model, often called the principal agent problem. If an MGA is solely incentivized by top-line volume, they will eventually ruin the carrier's loss ratio.
So how does Hippo avoid that?
They mitigate this in two ways. First, they only partner with highly vetted, long-tenured MGAs with proven track records of profitable underwriting. Second, and more importantly, they use their technology platform to monitor the MGA's underwriting in real time.
That perfectly transitions into the technology discussion, which is where the numbers on this transcript start to look almost impossible. Let's look at their expenses.
Let's do it.
Gross written premium grew by 61%, yet their fixed expense ratio dropped a staggering 39 percentage points since the beginning of 2024, down to 29%.
Incredible leverage.
Furthermore, their net expense ratio dropped 8 points year over year, down to 45.4%. CFO Guy Zelter stated they are maintaining largely flat fixed expenses during a period of growth. I need you to explain the mechanics of this, because in a legacy insurance company, revenue growth moves in lockstep with headcount.
Traditionally, yes.
If you process 61% more premium, you inherently have more customer service calls, more endorsements to process, and more claims to adjust. You have to hire an army of human beings to handle that volume.
Yeah.
How is Hippo scaling revenue 61% without scaling their payroll?
This is where the tech in InsurTech is finally delivering hard Jeep profitable leverage. The answer is their proprietary artificial intelligence infrastructure. They haven't just bolted a chatbot onto their website. I mean, they have woven AI agents into the operational fabric of the company.
Okay.
Management highlighted 3 specific AI deployments on the call. First is Hannah. Hannah is their customer service AI. When a policyholder needs a copy of their declarations page, wants to update their billing information, or has a routine coverage question, Hannah handles it autonomously.
Wow, okay.
This intercepts thousands of routine interactions that would normally require a human sitting in a massive, expensive call center.
And the second AI agent they mentioned is Clara, which they use for first notice of loss, or FNOL. Walk us through how a legacy carrier handles FNOL versus how Clara handles it, because those first 24 hours of a claim are incredibly expensive.
Right. FNOL is the moment a customer realizes they have a problem and contacts the insurance company. Let's say a pipe bursts in your kitchen at 2 a.m.
A nightmare.
Yeah. In legacy system, you call an 800 number, you wait on hold for a call center employee who is reading a script, and they manually type your answers into a rigid software system. It takes time, it's prone to human error, and the claim sits in a queue until a human adjuster is assigned to it the next morning.
And what does Clara do differently?
Clara automates that entire intake process. The AI gathers the necessary data through conversational prompts, instantly categorizes the severity of the claim, and can autonomously kick off the initial mitigation process.
Like what?
Like dispatching a water extraction team right then and there without waiting for a human adjuster's approval. This strips an enormous amount of administrative time out of the claims process, allowing the human adjusters to focus entirely on investigating complex coverage issues rather than just doing data entry.
That covers the operational side. But maintaining and upgrading these AI systems usually requires an army of highly compensated software engineers. Tech talent is incredibly expensive. How are they controlling their engineering costs?
This is the most fascinating technological deployment they discussed. They have integrated an AI software engineer named Devin, developed by a company called Cognition. McCaffrey noted that Devin is now deployed across nearly 1/3 of Hippo's entire 500-person technology organization.
Wait, they have an AI agent that is actually writing code alongside their human engineers?
Yes.
How does that even work in a secure enterprise environment?
Devin operates as an autonomous coding assistant. It doesn't just autocomplete text. It can be assigned routine engineering tasks. A human engineer can instruct Devin to write a specific script, debug a piece of code, or run automated testing protocols.
That's crazy.
It is. Devin goes into a sandbox environment, writes the code, tests it, fixes its own errors, and then presents the finished product to the human engineer for final review. McCaffrey framed this as making our best people even better at building.
So it's a massive force multiplier.
Exactly. Instead of hiring 3 new junior developers to handle routine coding tasks, a single senior engineer can oversee Devin to accomplish the same output. That is the physical mechanism behind keeping fixed expenses flat while growing the business 61%. They decoupled revenue growth from headcount growth.
And that technology isn't just an internal cost-saving measure. It is actively functioning as a customer acquisition tool in the B2B space.
Yes.
Here's where it gets really interesting, because there's a specific quote from McCaffrey regarding their data ingestion that I think is the most critical operational detail in the transcript. He stated that their fully automated platform has shortened the bordereau integration from new programs by 90%.
Such a great stat.
Now, for the retail investor, the word bordereau sounds like a regional French wine. We need to dissect what this actually means in the insurance world, because my understanding is that processing these files is the absolute bane of existence for legacy carriers.
A bordereau is essentially a massive, complex data dump. Let's go back to our MGA example. Hippo acts as the carrier for over 50 different MGA programs. These MGAs are out in the wild, underwriting policies and collecting premiums every single day. At the end of the month, the MGA must send Hippo a comprehensive report, the bordereau, detailing every single risk they took on. This file includes the names of the insureds, the property addresses, the coverage limits, the premiums charged, and any claims filed.
And the problem is that there's no universal standard for this data, right?
Exactly. Imagine it's 1995, and you are a legacy carrier. You have 50 different MGAs. One MGA sends you their bordereau as an Excel spreadsheet with 200 columns. Another MGA uses a proprietary software system that spits out a CSV file formatted completely differently. A third MGA sends a massive PDF.
What a nightmare.
The legacy carrier receives these 50 chaotic files and has to employ a room full of data entry clerks and lower-level actuaries to manually map, standardize, and integrate this data into the carrier's central risk management system.
Which takes weeks or sometimes months to reconcile.
It takes an excruciating amount of time. And because it takes so long, legacy carriers are effectively managing their risk blindfolded. By the time the data entry team finishes integrating the January bordereau, it is already mid-March.
Right.
If one of those MGAs accidentally underwrote too many policies in a concentrated hurricane zone, the carrier doesn't realize their capital is overexposed until it's too late.
So when Hippo says they reduced bordereau integration time by 90% using automated data ingestion, they aren't just saving money on data entry clerks. They are achieving near real-time visibility into their global risk aggregation.
That is the real value proposition. The AI ingestion engine reads the disparate formats, instantly maps the data to Hippo's central schema, and populates their risk dashboards. Hippo can see their true exposure in real time.
Wow.
If an MGA starts writing bad business, Hippo can instantly flag it and adjust the underwriting guidelines before the problem metastasizes. Furthermore, this speed is incredibly attractive to the MGAs themselves. When a high-quality MGA is deciding which carrier to partner with, they want a carrier that can integrate their data seamlessly and provide them with real-time feedback, not a carrier that takes 6 weeks to process a spreadsheet.
which explains why Hippo exceeded 50 active programs in this quarter, effectively doubling their program count year over year. They are becoming the infrastructure platform of choice because their tech stack makes the MGAs more efficient.
Exactly.
This operational leverage sets up the third major component of the earnings call, which is management guidance. If the Q2 results were impressive, the forward-looking projections are borderline aggressive.
They really are.
They raised their 2026 guidance across the board. Gross written premium is now expected to hit between $1.65 billion and $1.7 billion. Adjusted net income guidance was raised to a range of $62 million to $70 million, and they lowered their expected net combined ratio to a range of 99% to 101%. But the real shockwave was what they did with their long-term targets.
The revision of the long-term targets is where management is really planting their flag. Previously, they had set specific financial goals for the year 2028. Based on the momentum they are seeing right now, they announced on this call that they expect to hit those 2028 goals by 2027, a full year ahead of schedule.
Which is huge.
Because of that acceleration, they established new, significantly higher benchmarks for 2028. They are now targeting a gross written premium of more than $2.5 billion, which represents a 32% compounded annual growth rate. And they doubled their 2028 adjusted net income target to more than $140 million.
So what does this all mean? I look at a 32% compounded annual growth rate in an industry as mature and highly regulated as insurance, and my immediate reaction is deep skepticism. How do you reliably project a 32% CAGR without assuming you're just going to recklessly underprice the market to buy volume? Where is this massive, predictable growth actually coming from?
It comes from highly structured programmatic partnerships that basically lock in future volume. The most prominent example discussed on the call is their recently announced partnership with Accelerant.
Okay, what is Accelerant?
Accelerant is a massive data and technology platform that serves as a nexus for MGAs. They provide underwriting tools, data analytics, and modeling to a huge network of specialized MGAs. By partnering with Accelerant, Hippo becomes a preferred integrated capacity provider for that entire ecosystem.
Got it.
Management didn't just offer vague optimism about this partnership either. They quantified it. They stated explicitly that the Accelerant partnership alone is expected to generate in excess of $500 million in premium for Hippo in the year 2027.
That is a staggering figure for a single partnership.
It is, but it removes the guesswork from their projections. When you have line of sight on $500 million of premium flowing through a highly vetted, technologically integrated pipeline, hitting a $2.5 billion target in 2028 transitions from aspirational marketing to a mathematical probability.
We also need to factor in their consumer-facing partnerships, specifically the expansion with Progressive. Guy Zeltser mentioned they are currently live with Progressive in 8 states, but they plan to triple that footprint by year-end.
It's a great move.
This is a brilliant customer acquisition strategy. Progressive spends billions of dollars on advertising to acquire auto insurance customers. Those customers inevitably ask to bundle their home insurance. Progressive hands those leads over to Hippo.
Right.
But because Hippo has locked down their underwriting discipline, they only quote the homeowners who actually fit their profitable risk profile. They get to draft off Progressive's massive top-of-funnel marketing spend while applying a very strict filtration system to ensure they don't take on bad risks.
It is highly efficient customer acquisition. But if a company is going to grow at a 32% CAGR, taking their top line to $2.5 billion, they face a massive structural hurdle, which is capital requirements.
All right.
State regulators require insurance companies to hold a certain amount of capital in reserve based on the total amount of risk they are bearing. If you grow premium that fast, you usually have to go back to the equity markets, issue more stock, dilute your shareholders, and raise more capital just to satisfy the regulators.
Which investors hate.
Exactly. The fact that Hippo is projecting this hypergrowth without announcing a massive capital raise means they are utilizing sophisticated financial engineering on the back end.
I am so glad you brought this up because the transcript details a reinsurance shift that seems incredibly dense but clearly holds the key to their capital efficiency. McCatherine discussed implementing a whole account quota share and moving their catastrophe reinsurance to the corporate group level, which lowered their PMLs by more than 30%.
Right.
I understand that reinsurance is basically insurance for the insurance company, but I need you to walk us through these specific mechanisms. Let's start with the quota share. What does a whole account quota share actually do for their balance sheet?
Think of a quota share agreement like syndicating a massive commercial real estate loan. Imagine you are a mid-sized regional bank. A developer comes to you and wants a $1 billion loan to build a skyscraper. You have the expertise to underwrite the loan, and you want the relationship. But if you hold that entire billion-dollar note on your balance sheet and the building defaults, your bank goes under. The concentration of risk is too high. So you originate the loan, but you instantly turn around and sell off 80% of it to 5 massive global investment banks.
You syndicate the risk.
Exactly. You keep 20% of the risk, you keep 20% of the interest, and you take an origination fee for doing the underwriting and paperwork. More importantly, by offloading that 80%, you instantly free up your regulatory capital, allowing you to go originate 100 more loans for smaller local businesses.
Wow, okay.
That is exactly what a quota share reinsurance treaty does for Hippo. They write the policies, but they cede a fixed percentage of the premiums and the losses to massive global reinsurers like Swiss Re or Munich Re.
So it's basically a release valve.
Right. By implementing a whole account quota share across their entire portfolio, Hippo created a massive release valve. As they grow toward that $2.5 billion target, they don't have to hoard cash. They simply syndicate a portion of the total risk pool to the global reinsurance market.
That makes perfect sense. It allows infinite scalability without shareholder dilution. Now, what about moving the catastrophe reinsurance to the corporate group level? And what is a PML?
PML stands for probable maximum loss. It is a catastrophic modeling metric that regulators and ratings agencies use to stress test a company. It asks, if a 1 in 100-year disaster occurs, say a Category 5 hurricane hits Miami directly, what is the absolute worst-case financial hit the company will take?
Got it.
Previously, Hippo was buying their catastrophe reinsurance on a program-by-program basis.
Which means if they had 50 different MGA programs, they were essentially buying 50 separate reinsurance umbrellas.
Right. And that is incredibly inefficient because it ignores geographic diversification. Think about it. A devastating hurricane in Florida is not going to trigger a catastrophic wildfire in California or a severe convective hailstorm in Texas at the exact same moment.
Hopefully not.
Right. If you buy reinsurance for each program individually, you are overpaying because you are insuring against the statistical impossibility that every single program suffers a 1 in 100-year loss simultaneously.
Ah, I see. By moving the reinsurance to the corporate group level, they're buying one massive umbrella that covers the entire enterprise.
Exactly. They aggregate the risk. The geographic and peril diversification at the corporate level smooths out the volatility. A spike in losses in the Southeast is offset by profitability in the Northwest.
Which lowers the overall risk profile.
Yep. And by restructuring their reinsurance this way, Hippo lowered their probable maximum loss by 30%. Their absolute worst-case scenario is mathematically 30% less damaging to their balance sheet than it was previously. This is a masterclass in capital efficiency.
It really is.
As McCatherine stated, this reduces our volatility, improves our economics, and gives our partners more room to grow. If an MGA wants to expand rapidly in a specific state, Hippo can authorize it because the corporate level net is broad enough and strong enough to absorb localized volatility.
Which brings us to the bottom line. We have waded deep into the weeds today, looking at everything from the 95.8% combined ratio and the intricacies of the E&S market to AI coding agents and whole count quota shares. But as investors, we have to synthesize all of this data into a cohesive thesis.
Absolutely.
When I look at this Q2 2026 transcript, I see a company that has successfully navigated one of the most hostile macro environments in the history of property and casualty insurance. They executed 200 rate filings to force rate adequacy. They ruthlessly cut fixed expenses down to 29% utilizing AI. They completely revamped their reinsurance structure to protect their balance sheet. And they are leveraging tech to become the infrastructure of choice for the MGA market. I have to view this as a deeply structurally bullish signal.
The bullish thesis is incredibly strong here because the financial results are finally matching the technological promise. For the retail investor holding or evaluating the stock, the actionable takeaway is that you must discard the outdated 2021 narrative.
Toss it out.
Yeah. If you are running financial models that value Hippo purely as a direct-to-consumer homeowners brand that is highly susceptible to localized weather events, your model is broken. Homeowners is now less than a quarter of their gross written premium.
They've completely pivoted.
They have successfully mutated into a highly diversified, technology-leveraged program carrier. They are a B2B infrastructure play now. They are providing the regulatory paper, the automated data ingestion, the AI servicing agents, and the aggregated reinsurance structure for dozens of specialized insurance operators. They take a cut of the premium for providing that flawless infrastructure while insulating their balance sheet through syndication.
They stopped trying to be the most popular storefront on the street, and instead decided to own the plumbing, the electricity, and the foundation of the entire shopping mall.
And if we connect this to the bigger picture, that transition is exactly why we are seeing 5 consecutive quarters of profitability and a realistic line of sight to a 32% CAGR. They are utilizing software margins to disrupt legacy carrier economics in a way that is structurally permanent.
Right.
Legacy carriers have expense ratios that are bloated by decades of technical debt, ancient mainframe computers, and massive human payrolls dedicated to manual data entry. Hippo dropped its fixed expense ratio 39 points because AI doesn't ask for a raise, doesn't need health benefits, and can process a bordereau in seconds rather than weeks. This raises an important question, though.
Which is?
We just spent an hour detailing how a nimble, AI-native carrier is hitting its 2028 financial goals a full year early by decoupling revenue growth from human headcount. If a company like Hippo can operate with an underlying ex-SATE loss ratio in the mid-40s and drive their fixed expenses down to 29% today, what happens to the rest of the industry over the next 5 years?
That is the million-dollar question.
How long until the massive century-old legacy carriers, saddled with fragmented databases and incredibly heavy administrative payrolls, start losing unrecoverable market share?
Exactly. If the future of the insurance industry is going to be determined by operational leverage and real-time data ingestion, the companies built on AI from the ground up aren't just competing. They are playing an entirely different game. Thank you for joining us for this extensive Talk Tickers deep dive. Keep questioning the consensus narrative, look closely at the underlying mechanisms, and we will see you next time.